Hello everyone, it's Jeff from the Systems Lab. Today having a look at euro dollar on the daily time frame. This is using the FXCM data. Now, one thing I want to point out with this, it's a little bit different looking at currencies, and with currencies, especially for market data for currencies, there tends to be a lot of it. So if you pay attention down here, the strategy backtester goes back really far. So this is like 1971 through until today. So it's like 50 plus years. So there's a lot of data here, much more than you would get when you're on other symbols. So bear that in mind when you're trying to just compare apples with apples. Sometimes you get a lot more data than you think. So this is over a long period. But I just wanted to show this. This is interesting because, well, the performance is pretty good, as you can see, almost 200% for a 10% drawdown. So that's a nice ratio that I like. 253 trades, a 41% win rate. And I want to point out that this specific configuration is using a 1% risk per trade, something that the newer PRX versions have available. And so I've set my position size model to percent account equity, and I set that for 1%. So that means that the size of the risk will grow as the account equity grows as well, right? Now, one other thing I wanted to point out here, just in the system stats, we can see that 1% risk here, where you see here the average losing trade, 1,400 bucks, but that's at 0.97%, so a little bit less than that 1R at 1%. But then the average win, 2.62. So that's a nice ratio, and they do that for us here at 2.7. So the wins are bigger than the losses, and the percent profitable is a little bit higher than maybe we would expect. It's often in the 30% range or something like that. Now, also bear in mind, if we look here, the largest losing trade was a 5% loss. And that was when the account must have been quite early on. And I'll show you how we can see that. If we look here, I happened to find it earlier. You see this particular trade here way back in 1972, so that drawdown. And if I click on the chart and then just make this small, I can see where that trade happened. And then it highlights something else that we should pay attention to. Look how patchy the data is. Now, really what's happening here, this is data from the 70s, we're only getting like a 1 closing price for the day. And now, I don't know if this is a bad tick or if there was something that happened just for one day on that day in 1972. Um, but obviously that means that our trade had a big sort of gap over or under our stop. And that's why it's counting it as a 5% loss. Now, if you pay attention here, and I did this a little bit earlier, so I'm going to cheat, somewhere around January, February 1986, the data goes from pretty patchy to pretty clean with open, high, low, closed data, and it starts to look a bit more normal. So you could always filter it down to try to just get through maybe some more realistic data from the actual day there. So just something to bear in mind when we're doing these long-term back tests. But yeah, I just want to point out a few things here that highlights that 1% risk per trade, how we can use that as a benefit for growing the risk along with the account equity as it grows, and then just showing some super long-term charts on some currencies here. So yeah, go and explore for yourselves, guys, and I will speak to you very shortly. Cheers, guys. Bye.